Top of the morning. Captain Ron here, Financial JQP, where I don a new tie each day and I review a myriad of portfolios using modern portfolio theory, giving you a glimpse into portfolio management and hopefully some education on how to manage your own portfolio going into the future. With better portfolio management, you will achieve better results. How's that tie looking? An Italian tie here, green. Today I'm going to summarize what I did with the big mutual fund search. I'm not going to go through all the details because it took forever. It's a big search. But before I get into that, a quick disclaimer, reminder everybody, this is for educational and entertainment purposes only. And with that, let's take a look at the slides. All right, we're calling this new portfolio the Mutual 2026. Okay, so the guidelines for finding these mutual funds, to help limit this, we're just going to look for bigger funds. And in the end, we want to be sector diversified, international diversified, containing 20% bonds. We want a mix of big and small stocks. And we don't want any more than 5% in any single company. This is a historical momentum-based search. Future returns will be different from the past, but the past gives us a feel for what will happen in the future. And company detailed research, we're going to delegate that to the mutual fund managers. That's the beauty of buying a mutual fund, is we're leveraging the work of others. They charge us a fee for that and provide a benefit. And the tools we're going to use the Fidelity mutual fund search tool to find the mutual funds. We'll use the efficientfrontier.com tools to find the efficient funds. And then we're going to use the Morningstar tools to help us tweak the funds so they are more diversified. We're going to use this diversified benchmark. This is a good portfolio. It will be a challenge to beat this. We'll build a new one, run them side by side, and this will be our benchmark. And then also, as a reminder, I did that similar search back February 21st, 2020, and we're trying to come up with a portfolio that will beat this one. And this one and that one are both designed as a retirement portfolio, pulling 5% out per year, so slightly higher than industry average of 4.5%. This one has a sustained rate of 5.9%. We're trying to improve on that. The new search, I narrowed the 8,500 mutual funds down to 1,400 by selecting funds that have no transaction fee on Fidelity, fund assets over $500 million, so bigger funds. And then I divided the search into two parts. This is high Morningstar ratings, greater than 10% return, and this is just returns of 2 to 10%. So we can find the bonds and other funds that will help diversify our portfolio. All right, and then what I did when I did the search, because the numbers are so big and I can only analyze 150 at a time with Portfolio Visualizer, I ran them through one category at a time. So I ran one category. I ended up running technology first, and I kept a couple technology winners and all the rest of them just so it bounced against the technology. So I wanted something that pulls that standard deviation back, so something that alternates with technology well. And then when I did that, I found the most efficient 78 funds out of that list and the building blocks for making our portfolio. So I took this list of 78, ran it through the Efficient Frontier again. Here's the 78. I looked for the tangential portfolio right here, and I came up with this list of 8 or 9 mutual funds that make up our initial efficient portfolio. Now, this portfolio is not diversified yet. It's just an initial search, gives us somewhere to start. We've gone from that 5,000 down to these 8, and then from this 8, we're going to expand so that we can come up with a diversified portfolio. Next, we're going to load that portfolio into Morningstar, and we want to set the diversification. We want 20% bonds. We want sectors roughly similar to the S&P. We want 15% international, and then we want to make sure we don't have any stock concentrations greater than 5%. And then I will iterate a little bit on those numbers in the end as needed to optimize that 5% withdrawal rate. So at 5% withdrawal rate, sometimes you want to have lower volatility is better than a higher return when you're withdrawing money. So we will tune that in the end. And note, this is not an equal weighted portfolio as many of the stock portfolios have been. Typically when I do a bunch of stocks, I make them equal weight because you're just finding good ones and it's hard to tell which is going to be the best one going in the future. So we just equal weight them. That's not the case with this. We want to spread this over the sectors. All right. So when I run this first one through, the first thing I notice is this not classified. I don't really know how to make not classified diversified. And if I go look, both of these AQR funds that came up as efficient, and we're not classified. So what I'm going to do is pull those out, and then I'll add those back in at the end, maybe 10% each, 5% each, something like that, see if they help in the end. But for now, I'm going to pull them out just so I can do sector diversification. And when I pull them out, the portfolio looks like this. Sector diversification looks like this. And so first thing you can see is the not classified is all gone. Clean that up. Then over here we can see we don't have enough bonds in this initial search. There's no basic materials, communication services, consumer defensive is a little low here. We might have too much healthcare. Might have too much utilities, although utilities are great in making a low volatility, high performing portfolio. And then also our large growth looks good. Small value is a little low too. So we could use some smaller value companies. First of all, look for the bonds. So I grabbed all the bonds out of that 78 list, ran them through the efficient frontier. I found these three. The tool kicked out the first one, BAIPX. This is probably a fine one, but it needs 10 years of history to do this optimization. So I just pulled those out. I'm going to use the other two as the bonds. For the international, I came through and I found these two, so I'll split those two for the international. And then to get some small, medium, and large general funds, I'll try these 4 funds, and then I'm going to iterate on these, come up with the diversification I need. Here, after iterating many times over many hours, I come up with this portfolio, and I did look at those Q funds that we pulled out in the beginning, and they didn't add much, so I just left them off. So we'll leave those off. It'd be fine if you add them. It might help to add them, but it's fine to leave them off. So I like the list. I like the diversification. The list is a little long. I wish it was shorter. So how do the numbers look? The bonds of the international looked really good. I'll probably use a few more bonds. Might look at increasing that in the future on a rebalance, but for now they're okay. The sector diversification looked great. The style size, still a little low on the smaller value, but large growth looks okay. So this is probably fine. And then the stock style looks terrific. Then if we go look at the stock concentration, again using Morningstar, X-ray, stock intersection, this is a great way to find this. We see that NVIDIA, as I mentioned in the other video, NVIDIA surfaces the top. It is less than 5% by a little bit. So this is okay. I did notice SpaceX here is in second place. I don't know if this is optimal going into the future, but we will leverage those mutual fund managers who pick these as winners. So putting this portfolio back in Portfolio Visualizer, we can see the performance of this portfolio historically has been awesome. Volatility is actually very low. -2 sigma for an aggressive portfolio like this is extremely low. We can see that our perpetual withdrawal rate is actually superior at 7.4%. This is crazy. This is a really good portfolio. It has checked most of the boxes at least, and it looks like a good one. Some notes about history. This is a historical search. No one can predict the future. We don't expect the next 10 years to look just like the last 10 years. But we did have good diversifications. We did limit the concentrations, and we do expect this to perform well. And with high confidence, this portfolio should be similar to, if not better than, the other 2 portfolios that we're running it up against. We'll see how this does against that 2020 portfolio. Remember, that 2020 portfolio's got a lot more financials in it than tech at the top of the stock concentration. So remember, it had Visa at the top, and it's done quite well. And the diversified portfolio, that's a good one. It's also got the NVIDIA at the top. Okay, so what could go wrong with this? Where's our risk? So a couple of things. We are depending on these mutual fund managers to correctly manage these mutual funds. And mutual fund managers do have turnover. And turnover does affect performance. And then we could have another major natural or man-made disaster that affects the markets. So the markets as a whole can go down. They do go down. They generally recover. Some recoveries take longer than others, depending on what is going on. And then the performance of this is strongly based on the U.S. financial system. If something undermines that, that'll also have a negative effect on that. So what can we do for the managers? Let's monitor performance. If performance of one of these mutual funds drops off to where it shouldn't be, let's go look and see what happens with the management. And if needed, we'll flip that over, put a new different one in with similar sector diversification. Historically, the best way to deal with these big market swings is rebalancing. When the market swings, let's do our 2-year rebalance and take advantage of those low prices for the stuff that's gone down, because we know it'll come back. And then if we find that the U.S. financial system does have challenges, we can always move some of that money overseas. We've got an overseas investment in there, and we can always increase that if we think something's negative is going on here. The important thing here is the process. We sifted through thousands of funds to come up with a list of 20 or so. We used the portfolio visualizer to sift by category to get each category down to 2, 3, 4, 5 mutual funds. And we iterated with Morningstar to get the diversification that we wanted. The portfolio in the end is called Mutual One. We'll start tracking that in the future. You'll see that update. This is going to be mostly a buy and hold. I would expect it to go up slowly. It's a huge list of companies, so it won't be very volatile as compared to one of those stock funds. And ideally, this will beat those two benchmarks that we have, the 2020 portfolio and that diversified benchmark. But we'll also run those two in parallel with this and keep an eye on that. I'll put that fictitious $10,000 out there and we'll see what happens. So a couple notes here. So when I did the search, one of the initial search criteria was to limit the transaction fees. If we include those transaction fees, this would change the result a little. Because this is a buy and hold, sometimes those don't matter, but I wanted to limit that, give me a shorter list. We might want to redo this with transaction fees and look at those in terms of a buy and hold. We would come up with a different list. And when I did this, also I ignored the minimum investment in each of the funds. So you'll see that I've got 400 in here, 600 in here to come up with the 10,000. When you trade this on Fidelity, you can't actually trade those dollar amounts that are in that fictitious $10,000 portfolio. You've got to go to the minimum. Half of these have a minimum of $2,500. So this is designed for a much bigger portfolio. The Fidelity ones don't have any minimum, but all the rest do have either 1,000 or 2,500. And also, this is a long list. I would have preferred to have the list half as long. I did like the results, so I left it the way it is, but we might want to look at limiting the number of mutual funds in the list. All right, and as a reminder, the portfolio matters. And with that, top of the morning, wishing everybody a chew and happy portfolio management.